If we don't have time to answer them today, we will certainly do so in return. Without further ado, I would like to start this afternoon's webinar, Shockproofing Mortgage Pricing in the New Normal. Before we do that, I just want to make a few introductions. Let me start with myself. I'm Peter Reynolds. I'm the Global Head of Banking here at Ernix. I'm actually based in London, so anyone with a sharp ear will hear that I'm having to think to say good afternoon. It's early in the morning here in London. I have my colleague Giovanni, who's the Head of Professional Services Banking at Ernix, based in Tel Aviv. And we are very, very happy to walk you through this webinar. Today we have attendees, as well as ourselves, from London and Tel Aviv. We have attendees from Asia, Australia, New Zealand. We actually did a what we like to call a dry run for the Europe and American markets yesterday, which went very well. But that was just purely to perfect it for this version of the webinar. So a very good afternoon, on that, I'm going to take us straight into the webinar. So we're going to start. I think the best thing for us to do is start with why pricing in mortgages is important. And then we're going to walk through each of these points in more detail. But definitely, I think the place to start is why is pricing important when it comes to mortgages? Giovanni, maybe you can kick us off.
Yeah, so good afternoon, Pete, and good afternoon, everyone. And thanks for joining us. I think it will be probably a little bit preaching to the choir to talk about the importance of pricing in mortgages, since a lot of the attendees to this seminar are actually involved in pricing and in managing mortgages. But I think what we would like to stress is the fact that pricing is not just strategically important for the bank, but needs to have some specific characteristics that are very peculiar to mortgage lending rather than other lending activities and lines of business like unsecured lending, credit cards, and other types of retail products. And the reason it's strategic is because if you don't have some of these characteristics in your pricing processes and mechanisms, then you really are at a disadvantage with respect to the competition and also from an organizational point of view. So 4 of the characteristics that I think we can identify as being crucial for a pricing operation is that it is timely, competitive, accurate, and compliant. And let me walk you through very briefly what we mean by each of these characteristics. Timely is very important right now, especially in this post-corona or still in corona situation. The need to have quick reactions to the markets and to the economic conditions that are underlying the movements in personal characteristics of the demand that the bank face and real estate market characteristics is really, really crucial. The need to have a deployment strategy for pricing that is in real time and allows you to react on a weekly basis has been only highlighted in the past 2 months in many, many countries around the world. And it goes hand in hand with the need to be competitive. And in such a low interest rate environment where spreads between different lenders of a few basis points can drive large amounts of demand, being competitive and staying on top of the markets and being able to react fast from a pricing perspective becomes even more crucial. And the third point is being accurate. And by accurate, what I think we all understand is the fact that accurate means you need to be very granular in pricing and offer pricing solutions that really meet the needs, I would say, of micro segments, if not of the single customer. Um, the last point, which is probably from an operational point of view even more important, is being compliant from an auditing perspective, but also compliant with different procedures within the banks with respect to approval characteristics of the process, um, the impact of pricing strategies on credit exposure for mortgage books. We know how crucial that is. So having a strong compliance mechanism in place for the end-to-end pricing process is definitely one of the most important characteristics. So if you take together all these four elements, Peter, I think that it's clear that on top of the strategic importance for lenders, having a pricing mechanism that defines itself by meeting these characteristics is become even more crucial in this new normal that we're facing.
Yeah, I think that's absolutely right, Giovanni. It's interesting around the world, obviously, the idea of being timely with pricing, obviously being competitive and accurate with pricing. Compliant and compliance takes a different, as important mold wherever you are in the world. We haven't got time to kind of dive deep into the kind of front book, back book kind of issues or things to focus on in such as the Aussie market. But obviously, we're quite lucky, really. A lot of the Australian banks have got a lot of people we know from the UK working at, and we've had a real good chance to have lots of conversations about it, and some of the similarities between the UK and Aussie market when it comes to those items are interesting. Maybe that could be almost a webinar in itself one day. But let's push forward. One of the things I want to look at is globally, we see a very different change in demand around the world for mortgages.
Yeah, so this is actually an interesting picture that was presented recently for the North American market. And it's only one dimension in which we can analyze the different demand components for mortgages, which is what is the fraction of total front book origination that comes from remortgages as opposed to purchase, so refinance as opposed to purchase. But I think that in the immediate afterwards of the hitting of the corona crisis, what we saw not only in North America but also in Europe is that there has been a very rapid shift in the composition, the mix of business, in composition of the demand for mortgages. And one of the characteristics, as I said, is the fact that suddenly we have a surge in origination for refinancing and remo. This has been true in the UK, in North America, but it's not only in those markets. And it is something that is definitely related to the business cycle. Usually it's something that we see happening at the beginning of a recession. It's related to the very low interest rate environment that has been in place. And now with the intervention by central banks in the recent past, of course, this also there's been a push for remortgage, but most importantly, it's been related to the changed economic conditions in which consumers find themselves, the extreme shocks to income and job stability that we have seen in the past month or so have, of course, triggered a lot of actions, being there government actions or unilateral actions by the banks to provide holiday and respite to the economic hardship faced by their consumers, but more in general, also some behavioral responses by customers in terms of facing new economic conditions and then asking for remortgages. So, the Federal Reserve in the United States, it has different monitoring tools for monitoring the lending market for mortgages. One of them is the Beige Book that they published on a monthly basis. And one of the latest editions of that actually showed this huge increase in refinancing, and at the same time, it stressed some secular movements in the market, as was the stable demand for equity-related lines of credit, which are usually also managed as part of the mortgage books. In at least in some of the markets. And so what we see and what we foresee is that there will be very large swings in the composition of the demand for mortgages by consumers in the next, I would say, 12, 18 months. And banks will face the need to respond to these rapid shifts in the composition. And one of the needs will be to adjust relative prices across different products.
Yeah. I think let's open a poll while I comment on that. So I'm going to open a quick poll here and talk about how has the mix in mortgage demand changed over the past 3 months? No change, large increase in new mortgage requests, large increase in remortgage requests, and change is just linked to the payment holidays. The reason I wanted to kind of open that out while we're talking is one of the questions or comments that came up last night or yesterday when we did this, Giovanni, was that there's two types of this change. Firstly, there's panic change. So, there's a pandemic or something like this, and people run out of money and they need to do things like refinance. And then there's actually the more dangerous thing that happens, which is the 2 or 3 years of people being in different financial situations and looking to refinance at the same time as obviously other banks become uber competitive to win good business. And actually, the point of the webinar yesterday was, yes, we need to deal with today, but actually going out for the next 18, 24 months is actually where it becomes more dangerous because it's a competitive reason people are doing it. Well, what do you think to that?
Yeah, I totally agree that there are these two components to it. And as I said, there are kind of more secular trends, if you want, that already have been in place for a few months and a few years in the change in the mix of demand that banks are facing. And on top of that, there was this huge emergency component that was added on top of it. So from an operational point of view, I'm pretty sure that most of the attendees will be recognizing the fact that in the past month or two, most of the operational resources in the bank have been deployed actually to attend to the need for these emergency actions.
Yeah.
And this is definitely something that we don't foresee as being the new reality in the coming years. But if you add this on top of these secular trends, then what you see is actually the need to have a more systematized way of answering fast shifting economic conditions and to react from a pricing perspective in a timely manner.
And we've got mainly the poll today. Yesterday, obviously, we represented Europe, Africa, and the US. Today, it's mainly Australia, and you're about 50-50. So large increase in remortgages, and then volume changes linked to payment holidays. So that's similar to a stat you're getting around the world. That's similar, right?
Yeah. And I think, again, it reflects the reality of these past months. Probably if you were to ask this, in January, you would get a higher, of course, a higher percentage in remortgage request. But for the payment holiday, we think that it will probably taper off in H2. Having said that, blanket renewal of this or blanket cancellation of these holidays is still being perceived as something that is not really feasible in
Yeah.
many markets, and regulators are trying to give an answer to this need.
I think an interesting point before we move on that came up yesterday is one thing no one's factored into their predictions or models, and because none of us know, and we'll talk a bit about models changing in a minute, is could there be a massive impact in people wanting to move properties? For example, if you lived in a 2-bedroom fancy apartment in Sydney, which in November last year seemed like a great place to be, and suddenly having 2 kids, you now want to move out of town and have a garden because you've just been shut down for 10 weeks. What impact's that going to have on the market? But that's something that, failing to see my crystal ball, we probably have to wait and see those kind of changes. And another change I want to take us to, Giovanni, and we're working with a number of banks around the world on this, is a industry shift to move from a product catalog, which you fit yourself into, as in, yes, I do want a 5-year floating rate mortgage of X, to a tailor-made mortgage for one. And there's a shift where we're definitely seeing banks trying to be very competitive and almost tailor a mortgage or lending package around the end consumer. Maybe just walk us through that.
Yeah, I think this is a trend that actually is not new in the coronavirus era, but it's something that we've seen in the past year or so happening in reality. I think now it's the need to go to this type of solutions, which are, as you said, have some sort of tailor-made offer for the single customer that is not picked from a pre-existing list of economic condition for the different contracts, is driven by 2 forces. One is the fact that in such a low interest rate environment, competition is being really very, very high. And as I said, small differentials in offerings, whether it's fees, whether it's cashback, whether it's, of course, the interest rate. These small differentials in interest rate, even 1 or 2 basis points, can drive relatively large volumes away or towards the lender. If you are in a situation like this, then of course the natural thing to do is try to differentiate your offering in other dimensions, like the duration of the loan, the type of payment structure of the loan, and tailor make, try to find a tailored solution for the need of the single customer. So this is one aspect to it. I think that heightened economic competition has driven the need for a more tailored solution. The other one is also the sudden availability, not sudden, but the availability in the last couple of years, or a much better understanding of consumer behavior. And whether it's analyzing inflows and outflows from your credit card, from your checking account, or your expensive expenditure patterns on your credit card, having the ability to link this type of individual behavior analysis and analysis of the customer needs and changed economic conditions to the type of offering that banks are presenting to their customer. This is something that was not present, let's say, 5 years ago. And now a lot of our customers are embarking on a journey that will enable them to do this. And that also opens up the possibility for this type of tailored solution.
Yeah, I think what we're seeing around the world is the challenger banks have come into, obviously, banking with quite easy, fresh kind of infrastructures, and can offer tailor-made products quite simply. Most start, deposits, loans, and what have you, but everyone's looking at the challenge. Everyone's looking at the home loans market in different territories, including Australia. You even see some of the banks filing off and having their own kind of separate brands that are competing with challengers. So if you look at Ubank, which I think is NAB's offering, that's a kind of fresh, almost challenger bank of part of a big bank. So I think one of the things we'll see is the demand for personalized products is going to come from the consumer, because hey, when I go to Amazon, it doesn't say, do you want a coat, and here's 3, choose one. It says, hey Pete, we noticed you went skiing and we know you go in February, although I wish this year. We know you spend $200 on a ski jacket. It's November, you haven't bought one this year, you haven't bought one for the last 3 years, so here's a ski jacket in the color that you tend to buy at the price you tend to buy, that can be delivered through Prime. While I might not want a ski jacket that year, it doesn't offend me that that's what it's trying to sell me. So I think the consumer will lead to a demand in tailored products. I think the challenger banks, at least what we see, I've got a lot of experience in the UK because I bank with both a challenger and a mainstream bank. The challenger banks will get out to market very quickly with some level of tailored pricing, but then it's the opportunity of the big banks who have all the data to actually come in and try and compete with that, and become a bank based on data and analytics to start offering these front end products. So I think it's a very, very interesting journey. I want to walk through something here that is aimed at, I'm not trying to aim this at pandemic. I think people are getting a bit bored of webinars that talk about pandemic, but in general, I want to move on to automation. So while we start, let's just talk about automation very quickly. So a quick poll so we can frame it. How automated is the pricing process for mortgages? So firstly, we have a fully end-to-end automation. Secondly, we have automated processes that support pricing. And then thirdly, we have a manual pricing process. Giovanni, let's go to the next slide and I'll come back and we can talk about the results after you've kind of introduced us to automation.
Right. So automation, of course, is a big word that talks about different processes. I think what we would like to focus here is more specifically on the pricing aspects of the different processes related to mortgages. And if we think of an end-to-end journey in terms of pricing processes, there are many layers to it. I think the first layer is what we would call the analytical one. So the models upon which the pricing decisions are based, whether it's financial models or behavioral models for consumer behavior, price sensitivity models, demand models in different aspects, and product choice models. So this is one element of the funnel, if you want, of the operations for pricing. And the second one is the decision-making process. So how much of the decision-making process can be automated or partially automated, especially if you're looking at changes that are done at relatively high frequency, several times a week. The third part I would focus on probably is the deployment process. So here, what I want to point to is that while the decision-making process probably could benefit marginally from automation, but not entirely, because the human component to it, of course, is very important. And within a pricing committee, being able to share information in a timely manner and be able to have a full view of the market conditions and the bank's financial condition before making the decision is crucial. I think the two aspects of automation here are the ones where we see most of the action coming into place. And the one is on the analytical side, the monitoring of the predictive models and of their accuracy, whether it's positioning with regard to your of your pricing with regard to your competitors, or whether it's predicting behavior. And the second part is the deployment, so the end of the funnel, if you want. On these two elements, on these two activities, we see a lot of action, and it's almost impossible today for a bank that doesn't have an automated monitoring process for their predictive models to keep up with the changes that we're seeing happening on a weekly basis, and the need to retest and redeploy new predictive models. And at the same time, it's almost impossible if you don't have an automated deployment process that is timely and has a very short lifespan of a few hours, I would say, to change prices on multiple times a week, as is needed sometimes in the current conditions. So I think that these are the two spheres where we see most of the action coming into play in the last year or so. And those who invested early on the automation of these processes are definitely at an advantage today, I think.
Yeah, I think from let me just, it's interesting, the polling system we have here sums up. So I don't know if it's exactly the same because it's summing up to nice percentages for me here, but it's exactly the same percentages we got on the global webinar. So 75% of people have a manual pricing process, 25% of automated process that support pricing. And I think, as you said, Giovanni, yesterday, we have a full end-to-end automation is kind of a trick question, right? You're never going to automate everything and kind of sit on Bondi Beach and chill while the pricing's done for you. I get that. But it's interesting that, again, a complete manual pricing process. Just reflect on one thing, Giovanni, quickly. We see a lot of banks, again, not to talk too much about, this isn't a COVID webinar, but a lot of banks, at least assuming at some point in the future, they will be in a very competitive situation with mortgages, fighting for refinancing and new deals, and will have a shutdown maybe at some point where everything has to be done away from the office. Be interesting just to get your thoughts on that.
Yeah, I mean, I think both you, Pete, and myself are actually taking this webinar from home, something that we probably wouldn't have done 4 months ago. But the automation is also part of this need to have a much more agile way of working from an IT perspective. So yeah, I agree with you that this is not something that has necessarily to do with the COVID situation.
Yeah, and we see a huge trend that digitization is accelerating, and this isn't at all. This started a long time before. I find it slightly funny that there's a lot of news that you should now digitize your bank. I don't think that's the case. I think banks have been digitizing for a long time. I think the question that has been brought in here is that how quickly should we digitize all our bank? What parts of the bank? And more importantly, what we're seeing is, who do we want to go after with digitization? I spent a lot of time working with a customer in Italy that said digitization has absolutely increased to the people that like digital banking, but there's still people who don't. And you can't just someone who's gone into a branch every week for the last 40 years, you can't just say that's gone. But that said, banks are looking to how can they automate and digitize the entire process for many products. Some products are quite simple, just because there's just an easy way of doing it. Whereas mortgages, you're always going to find big problems around it because of compliance, because of regulation, because of third parties, because of the way mortgages are sold, and frankly, because of the emotional connection to a mortgage. Most people, when they're buying a property, it's a big part of their life, and how are you going to replace that warm feeling you get from an advisor who's walking you through your options? On this slide, you talk about some of the things our customers are looking at, which is very, very, very interesting.
So I actually agree with you that this is something that has been in place for quite some time. So digitization is not, of course, is not something that is new to banks. But in many situations now, the need to onboard and migrate customer journeys to being at completely digital journeys it has been just a must because of the inability of customers to reach their branches or because of lockdown. So this is just an extreme example. But I think that in mortgages, what we're seeing, as opposed to some other lines of businesses, is that digitization has been taken a specific path. So mortgages, the issue of mortgage is a very complex procedure, unlike unsecured personal lending, where it's pretty common nowadays to go online or your app and being able to close a small loan in almost real time with no interaction with a human being, or maybe through you might have a small interaction through a chatbot that then points you to a real advisor. But in mortgages, of course, this is not the case. One, for several reasons, um, regulatory reason not being a small part of them. So what bank have been doing in the past has been basically digitization in that part that you see on the right hand side. You have RPAs and AI. All these processes are being digitized, mostly for the review, underwriting, for the pre-auditing part of the mortgage issue, and also for the post-closing. And of course, the fact that there are lenders that are not holding the mortgages, so there's the whole servicing part in mortgages that has been also highly digitized. I think that nowadays what we're seeing is that digitization is also aiming at giving more insights to the advisors to help the customers, as you said, in this emotionally charged decision. So I think that we will just see more and more of that in the coming years.
Yeah, and I think the powering that needs to be, from a mortgage point of view, an end-to-end systemized process. Give us a high level, Giovanni, of if you were running mortgages, what that process would be.
I'm thinking mostly about the pricing aspects of it, and if you think of the pricing cycle for a mortgage repricing decision in your portfolio, what you see is, first of all, many different actors are involved in it. You have IT, you have the pricing managers, you have the data scientists that service the models that are being reviewed and retrained and redeployed. Of course, you have marketing, you have also IT involved in deploying, you have third parties that are using the deployed prices. So all these players within the organization and outside are involved. And if you think about systemization within the bank, then it really becomes crucial that these players be able to interact using uniform services and platforms, so that the streamlining of the process is full and nothing is lost in translation, if you want. So the typical cycle would be you collect data on the market, maybe on a daily basis. You connect financial data from treasury and other sources. You retrain or check the validity of your predictive models, and then you make simulations about pricing changes and produce pricing strategies that are being then proposed to pricing committee. And once approved, then they are translated into pricing rules that go downstreams to the different front ends that interact with the customers and advisors and brokers. So this whole process, the ability to have a streamlined and systematized process that is sitting on a unified platform, this is something that has been at the forefront of the decision in investing by a lot of our customers, and we see this trend of trying to systematize the whole process being put in place in many continents. So it's not only something that we see in Europe or in North America. Of course, it's also in other parts of the world.
Okay, so let's take a look at some of the market conditions that have changed. Let's have a quick dive into this, Giovanni.
So, of course, at the forefront of what we're seeing now is different economic conditions that are faced in terms of income by most customers that are holding a mortgage. So on the back book, if you want, front book activity has been for new properties or for new purchases has been very, very slow in the past few months. We also have not seen yet the large impacts on the real estate market, so property values. at least we have not seen it in a massive way change in many markets. So this is something that definitely I think most forecasters are now starting to forecast for H2 and for the in the next few years, although there's a lot of uncertainty around it. But these unprecedented amounts of application for payment moratorium or payment holidays and general hardship applications have been the most significant burden to lenders' operations in the past few weeks. What we are almost sure is that there will be no blanket extensions to these payment holidays, and so there will be some in the immediate future. We will probably see some differentiated response to these to the ending of these payment holidays, and thus the need to be able to also differentiate the offering for the customers that already have a mortgage or for those who are now entering the home buying process for the first time. So I think that the ability to move in a quick and timely manner, the ability to move in these rapidly changing market conditions with a lot of uncertainty is one of the main features of pricing operations today, and those who are able to move in a timely manner will be advantaged definitely, and will be at the forefront of trying to lose less ground possible in the coming months.
Okay, let's talk about, let's move into analytics and systemizing analytics. We've talked a lot about the systemizing the process around pricing. Giovanni, let's just dive into analytics quickly.
Yeah, so analytics is part of the process, as we said. In every pricing operation, you have the analysts who are doing some simulation of what would happen, what will happen as a response to the price changes that the bank is proposing. This happens everywhere, and most of the time, this is based on some sort of predictive models. They could be simpler, they could be more complex, but everybody has some sort of idea of how the market will respond to changes in pricing by the bank, whether it's adapting to benchmarks and following the market leaders, or whether it is try to preempt them and try to be the first movers in the market. One thing that we have seen, and this is like a survey by McKinsey that was published recently, is that those financial institutions who invested heavily in AI, so in advanced analytics, artificial intelligence, and all the most advanced methods, if you want, for predictive modeling, have been differentiated in the return to these investments, not necessarily based on how much they invested, but on where and how they invested. So I think this slide, what this slide shows is that the main differentiators are actually on dimensions that enable advanced analytics to be readable, understandable, and to be effective across the organization. So it's more about investing in the mentality. The need to have a analytically driven operation is probably more important than just deploying some proof of concepts pilots and having some smart data scientists put in place one predictive model that has only marginal impact on the overall processes of the whole pricing operations. So I think this is an important point.
Yeah, so let's as we carry on with the subject, I just want to take a brief stop to take a poll. So how digitized is your bank's mortgage process? Customers can do everything online. Payment holiday can be completed online, nothing else. We have offers online, but you need to contact the bank. I understand we're not covering everything here. There's many different kind of comments to this, and we seem to usually, looking at yesterday, we have a high percentage around 0.3. So maybe we need to open up the questions next time we talk on mortgages. I'll come back to those answers, Giovanni. Let's just carry on talking about systemization of analytics.
Yeah, as we said, the need to put in place a kind of a analytic mentality, if you want, within the organization is one element. The other one is, in these conditions, the need to make decision, even if the analytics that you put in place is not considered perfect. You know, there's this famous saying that data scientists are never happy about their models because they always strive for perfection. And so today, the ability to make informed decisions based on models that might become less reliable as things change rapidly, or based on data that include a lot of uncertainty, is really heightened. So I think that one part of the systemization process for analytics is that even if you have imperfect data, and even if you are moving in an agile way of developing models that provide you with a first cut, like a MVP version, if you want, of your models that are not perfect and then are going to be improved incrementally. But having the ability already in place of doing that, of having, even with imperfect data and in imperfect models, the ability to make informed decision, this is really a big differentiator today. So we see a lot of customers reviewing their models, trying to check their validity, trying to check their accuracy. We see a lot of customers, reviewing the data flow, augmenting them with new data, and we see customers also trying to deploy newly trained models. Today, with automated AI, you can do it very quickly. But still, if you don't have a systematized process in place, the ability to translate this into real decision is really a challenge. And so I think that this actually points to this slides here that you just showed.
Yeah, dive into that, Giovanni. I think it's important to relate this to decisioning.
Yeah, so analytics, as we said, is part of the process, right? So it's not only about the models that you use to make predictions, although without models, it's very hard to have an informed decision. It's also about all the other elements that come into presenting a solution that is a proposal to pricing committee that is made from informed data. So what we call scenario analytics is basically the ability to put together all the data or the models, both from finance, from risk, from the competition in real time, of course, from customers' behavior, put them together and present a proposal that is not just some sort of manual or high-level decision that is being put in place, but has strong elements of dependency on real-time data. So scenario analytics, the ability to present that and then to go to pricing committee and say, okay, this is what we saw in the past week happening in the market. Even if we're not 100% confident about our predictive models, given our experience, we can say that most likely this scenario is going to produce the following outcomes. This, in the changing environments that we are facing today, this is really, really important, and and being able to do it with one platform that actually enables you to do this in a very, very quick turnaround time. This is it's something that we see many customers hoping that they had this ability and striving to achieve the goal of having this ability in the future.
Yeah, I'm just going to be very touched on this slide very, very quickly because we've talked about most of the issues or points, but taking that pricing into the different streams or channels, into the core systems, and then into the digital channel. But also we mustn't forget, it's huge into the branch advisors, the brokers. This is not today a completely digital process at all. And it's something that you have to think about, how do you deploy those prices across channels? But we've kind of touched on most of those points. So I'm actually going to skip across to, we talked earlier on, Giovanni, about personalizing a product for Peter, right? Rather than Peter choosing a mortgage from your catalog. Analytics has got a huge role in this. So walk us through this and kind of give your view on that.
Well, you can think of this, I would say, as the following. So think of an advisor that sits in front of Peter. Peter comes in, and Peter is buying a house, or Peter needs to refinance the mortgage that he opened 5 years ago with a bank. And now, what does the advisor do? What type of information the advisor collects about Peter? There's a conversation. Maybe the advisor knows Peter. He comes to you and he asks, what's going on in your life. So you basically describe what's going on, and then you are presented with some options. Now, think of this process as being informed not by the conversation you're having, which is probably a conversation that is triggered by some events that happened to you recently, but by actual data about your economic condition. As we said before, the flow of balance, the balances on your checking accounts in the last 6 months or 1 year, your expenses expenditure patterns on your credit card, what happened to your bonus, what happened to your salary in the past years, what happened to your partner or your spouse salaries, what's going on in the market in terms of your occupation. So what's happening to salaries of people who have the same job? What happens to market conditions in the real estate market for your property? So if you had a full view of this customer driven by actual data, this conversation could actually happen before Peter approaching the advisor and the relationship manager. And this conversation is enabled or can happen in such a way, so triggered by actual data analytics, only if the analytics is in place. So we see this as really the differentiator about a differentiator across different banks in the coming years. The ability for lenders to actually tailor a solution and an offering that is not just picked from an existing catalog, but that responds to the needs of the individual consumer or the individual customer of theirs, triggered and supported in terms of insights by analytics and not just by conversations and some sort of high-level experience of the advisor, which, by the way, in many times might not even be part of the organization that actually lends the money because of the structure of mortgage markets. So these type of consideration, I think, are becoming more and more crucial. So the ability to tailor the products, the features of the products, the length of the mortgage, the type of repayment schemes, the type of additional products that are attached to the mortgage, whether it's insurance, whether it's some sort of line of credit, whether it's other lending facilities for improvement or renovation, etc., etc. So the ability to base this on actual data about customer experience and customer behavior, I think this is becoming the new norm towards which banks are moving.
Okay, and let's just, as a last couple of slides before I do try and take a couple of questions. We've had some good ones. Giovanni, anything to add on process efficiency? We've talked a lot about this already, but maybe.
Yeah, I think we talked about this. It's today in process, and again we are going back now to the idea of what the pricing process is. So when you talk about the efficiency of the pricing process that are driven by analytics, um, what you see is that the main actors usually are the data scientists and the pricing specialists there. So basically taking their roles and their jobs and making them much more efficient and enabling them to put their time and effort into activities that really provide value to the whole process is one of the other things that systemization and digitalization is aiming for. And of course, the ability to do this is only enhanced if you have an integrated platform that supports both these uh, functions within the organization, the data scientist and the pricing specialist. So we at Earnix, being at the forefront of providing such platforms, we see how much value is brought to organizations by the mere fact that there is one platform that enables these players to sit together around the same table and interact on a daily basis using the same software. This is a huge improvement in the way they work.
Yeah, let me just bring it all together. The kind of end state, forget Corona, go back a year. You sit down with a bank and you talk about being able to detect stress and help a customer with a product, would have been absolutely the journey a lot of banks were on. So I can use analytics to detect. Let me use a loan example, and then we'll talk mortgages. I can detect stress from a customer by looking at inflows, outflows of transactions and say, oh, this guy Peter doesn't seem to have the same money or the same bonus, or he's lost his job, or whatever it might be. To say, well, hang on, he might need a loan, which is a simple thing to look at. And to then in real time say, hey, Pete, we've noticed X, Y, Z, or have you seen about the kind of professional loan we're giving? You can borrow $5,000 and it's going to be at this rate, which is all very personalized to me, and it's delivered over the digital channel. So there isn't a CEO or an innovation or a business lead that wouldn't see some value in that kind of a process, turning a please come to us for your loan to a proactive outreach to say, we know you need a loan, would you like it? It's almost like the Netflix of lending, right? Saying, here are the movies, we know you might like them, this one's great for you. Now I want to bring that into what we've seen in the last 3 months. Every country in the world and a lot of our customers have been dealing with payment holidays. And they've done, to deal with the demand, what they've done is say you can have a blanket holiday, 3 months, come to us, be it your mortgage, your car loan, whatever it might be, and just apply online or call us up, and as long as you can face certain criteria, we'll give you this holiday. Imagine a world where you turned analytics into that, which said, if you think of the detecting the stress in people who have been furloughed or lost their jobs or whatever it might be, didn't get a pay rise they usually get, would have been very, very simple had you had analytics and technology working. To automatically go to someone and say, hey, you qualify for our 3-month payment holiday, even if it was just taking one of the biggest chunks. So for example, in the UK, we had a bank that looked at furloughed people. It was very, very simple to pick up someone who had been furloughed. So that's very easy for us to do, to digitally send them did you know you can get a 3-month payment holiday? Here's the personalized offers for you, and click here if you want them. There's 2 things to think about there. Firstly, there's the moral side of it and the emotional side of it of not having to call the bank and say I've been furloughed, which I think is something that most people in the banks that manage to pull this kind of thing off loved. Secondly, there's the automation of the process and saying, here's a massive amount of flow we're going to get that we can literally take into a digital channel, because there are things we can do in an automated way. Even if there are certain KYC things we haven't worked out yet, we can still digitize this part. Now, I want to jump into, we have literally a few minutes, but there's some very interesting questions. We won't get through them all. But here's an interesting question, and Giovanni, let me phrase it before you panic too much about what I expect us to answer. But someone's asked, what's an example of an uncompliant pricing? And I don't necessarily want to, we can have a conversation offline and talk about our experience around that. But I did want to talk about how do we deal with pricing to make sure we have a process in place that makes sure whatever is a compliant process is followed. And I go back to a summit we had in London. Steve Rubenstein at the time, head of pricing for RBS. He's actually now in Australia. And he gave a very good presentation. And the bulk of his presentation on fair pricing said, the way he works is assume my pricing process will be published in one of the tabloids, and always think like that, and always make sure that anything I'm doing, I wouldn't mind someone seeing in full transparency. And then Giovanni, I rather than talk about what we've seen as an uncompliant pricing process, I'd love you to talk about the kind of way you can enable constraints to make sure that what your pricing process is something you want it to be. Maybe take a few minutes on that.
Yeah, so I think that from a pricing perspective, so of course compliance in mortgages comes into different stages of the mortgage offering, and one of the most important one is the time of the advisor actually sits and explains to the customer all the conditions. But in terms of pricing, the most important thing is transparency. So the ability to identify what are the elements that come into the pricing, the final rate that you're paid, or the final fees that you have to pay internally to the bank, but also externally to the customers in terms of compliance. The ability to explain where all this is coming from, and ability to trace and document all the decisions that have been made in order to explain that, whether it's which variables were used in the models, or which data, or which assumptions were used to make the pricing decision, and what discussions were held in pricing committee when the decisions were made. This ability to trace is crucial, I think. That's what I would define as a compliant pricing process. And so having a platform that actually brings this to life by automatically tracing where prices that are eventually deployed to market are coming from, and what the assumptions embedded in the different models and different simulations that are done, and also in the variables that are used to make up the final simulations and the prices. This is really, I think, part of what we would define as a completely compliant process.
We have run out of time. It is literally on the hour. I just want to say, firstly, thank you very much for everyone who joined us today. We really enjoy these kind of sessions. It's nice for us to have such an interactive audience. There's literally tens of questions that we will get to individually, and can, of course, set up sessions for anyone who wants further information. I want to say thank you very much to our speakers, as in this time Giovanni. Thank you for joining us. It's great to have you on for the second running of the mortgage webinar.
Thank you.
Also to our production team, we have behind the scenes, we have a number of people helping put together slides, present the kind of logistics. So thank you very, very much for everyone who joined. And yes, we will send you as much information as you need, but you can always come to us and look at our banking webinar series and download and look at those coming up. Appreciate everyone's time, and stay safe, and look forward to meeting you all in person. Thank you very, very much. That concludes today's webinar.